All right, so stock finished today, on a little bit of a sideways note. Finished the day down, but not down as nearly as much as we were, and really not down that much at all. It's been as we approach this resistance at the end of the month, the moves have been very tame to the upside and to the downside, and today was no different. The last couple of days have been relatively weak, but again, if this is as weak as we get, then that's actually a pretty darn good thing. But you'll notice underlying the surface was a pretty darn risk-off day, and I'm going to show you how it was, what some of these different asset classes did today, what the different sectors did. It's about as risk-off of a day that we've had in quite a while. So I'm going to break all that down, break down the major moves in the dollar and bonds as a reflection of what's going on with those rate hike odds. Big change in the rate hike odds today. We'll talk about that, the impact that will have, how likely that is to stick, especially with the unemployment rate schedule, jobs report scheduled for Friday. And then we'll take a look at our trade ideas that happen to be in one of the top performing sectors today. We'll talk about how to trade it as it made a little bit of a reversal to the upside. So let's go ahead and get started. Today is Wednesday, May the 31st, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going, I invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. If you're watching us on our blog, check out some of these other things over here on the right, including our Market Outlook live video I do at 3:30 Eastern time. Come down to the bottom, click this heart. It opens up this tab. Hit that like button, that like button there that pops up. Same thing here. Click on this thumbs up icon. It opens up this tab. Hit that like button down there. Again, the more you do that, it helps get our content out to all of our followers there. We got almost up to 100, which is our goal every day. So we always keep asking. So those who do like this video day in and day out, thank you very much. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. So we had a down day, our first down day in four. On last three, this is a third day in the last four that we closed lower than where we opened. So we've been gapping up and kind of falling throughout the day. In this case, gapping down and falling throughout the day. So we've had some filled-in candles. In fact, more filled-in candles than opened here in the past week plus. And as a result, you can see the short-term sentiment is not very strongly bullish at all. Momentum line's back into bearish territory in the lower reversal zone. The near-term line is out of bullish territory. Now, it's not, we've done this before, so it's not out of the... it's not in the bearish territory yet and starting a new low point. So that remains to be seen. The intermediate line is rising. It's still below market sentiment, which is also rising, and it's barely rising, has been for like 4 or 5 days now. So not very much of a move there going on. And like I said, the near-term line, that's a relatively bearish near-term peak when you can't get into the reversal zone and stay there. We barely dipped our toe in there and are already out of it. Let's look at the Dow Jones Industrial Average, so again showing a bearish posture. You still got this. It also produced a bearish near-term peak. Near-term line got its toe above the 80th percentile and already dropped down. Momentum line is in bearish territory, not too deep though. Intermediate line is actually rising, though it's still in that lower reversal zone. The Dow is still kind of flirting with that cluster low point that we had there. Market sentiment is still rising. It's bullish, not as bullish as the S&P, but still rising there. Of course, your NASDAQ 100 has been the most bullish. It's been close to a cluster the past few days. The near-term momentum line dipping down to near extreme levels, and the near-term line also coming out of the upper reversal zone, though still in bullish territory. And obviously an extreme peak up there, much higher than the last near-term peak, even though the near-term line itself is actually slightly lower. So somewhat of a near-term divergence there, that we'll see how much that plays out. Very small range today, very small drop, not really that big of a deal. but halting some of the momentum near a Fibonacci resistance level. There, the 23% retracement. Member, it's actually exceeded a few of these others important ones, the 50% retracement, the August peak, this August decline, August to October decline that we've been retracing everywhere. It's gotten above its 78% retracement for a while now. Now it's above the 100% line and up to that 23% level. And like I said, the 62% retracement level of the entire correction. So we barely got above the 50. We're already at the 62. See, that's not the case for the S&P 500. The S&P 500 is barely flirting with that 50% line. The 62% line's up here, well above the 23% retracement of the post-COVID rally in black. So a little bit, resistance here for the S&P. The Dow Jones also has similar resistance levels. It also hit that 62% retracement, though it's hit it a lot. Well above the 50% line. Now it's kind of flirting with getting back below the 50% line. There's that 78% retracement of the August to October decline that we've been retracing, like I said, everywhere for a while now, for months now. And then there's your 23% retracement of the post-COVID rally that we're still above. So not so bad there in the Dow. The Dow is basically cooling off a strong move it had late last year. The Russell 2000, on the other hand, has been by far more bearish. So again, it's the 23% retracement of the post-COVID rally is way off the chart. It's like way up here. We're nowhere near that level. The 50% retracement of the post-COVID rally is also at way up here at 2000. Again, nowhere near that level. And then there's the 78% retracement of this August to October decline. Again, we're nowhere near that level either. In fact, we're actually a lot closer to breaking below the 23% retracement and starting a new bearish decline. As you can see, the intermediate line's dropping, still above the 50th percentile, and you're below a falling moving average. You're almost back to having a bearish pattern there on the market forecast again after just a very, very brief bullish intermediate run. That again, that's a very bearish peak when the intermediate line can't get into the reversal zone during a bullish run and ends up rolling back over already. So again, you can see that this rarely ends up happening, and when you do get it, it's not a good sign, right? You can see over here was one, and we just ended up going down to new lows rather quickly there. Pretty bearish peak there, and that's really the only other one in the past couple of years. So not the best sign. The S&P, of course, that's not been the case. You were up in the upper reversal, and even if we've been below it for quite a while since, again, that peak never did get into the bullish territory on the S&P 500. So again, you see just how uncommon it is to form a peak in bullish territory, but not in the upper reversal zone. Let's take a look now at some of the monthly charts since we're ending a month here. So let's go to a 10-year monthly chart. And you can see on the S&P 500, we are actually back to dark green shading and a green line. So just like that, the intermediate line has turned, did not get in the bearish territory, didn't get below the 50th percentile even, has turned back up, hence the green shading. And then you have been now back above the moving average for the past 3 months. Though you can see the range, we went from 300-point range in March to 120-point range in April, to back to 182-point, a little bit bigger, but still very below average range here in May. And we're just sitting right at that 23% retracement, right at 4,200, and just kind of coiling there with the moving average. By the time we drop down here, the moving average is at that 38%. You can see with us spending pretty much a year going nowhere, down and then up, but essentially nowhere. We have the moving average has not gone nowhere, right? So we first hit it here in April of 2022. The moving average was down here, so we're back to that same April 2022 closing level, and we're way up here. The near-term line's in bullish territory at strong extreme levels and above the 90th percentile. So that's a good sign. With the momentum line dropping, it's not surprising with the two very small ranges we've been having here. And long-term market sentiment now is actually out of the reversal zone. So it's dropped down barely, but below the 80th percentile. And you can see we're not we're right at the moving average, hardly strong enough above it to make that much of a difference there. So that's your Dow. Your Dow, or your S&P. Your Dow Jones is a little bit more bearish. It actually produced it had a down month this month, to the point where it fell below the 30-day moving average by 1%. Produced a bull tag again. This is our third bull tag on the S&P. Again, either bull tags or either really good buy signals off of correction lows, or they start bear market declines. And so that's, you are above the 23% retracement. So as of right now, it is such the correction. But even your moving average is above the 23% retracement. You break below this, you're going to be back in the retracement mode and not so bullish there. You can see market sentiment's falling. Short-term sentiment not nearly as bullish as it was, kind of forming a bearish peak there. Of course, your NASDAQ, on the other hand, has been strongly bullish. It had been more bearish. In fact, the intermediate line actually got into bearish territory. The S&Ps, the Dows did not, right? So the NASDAQ had been a lot more bearish. The intermediate line just barely getting out of bearish territory now with a very strong short-term move, getting back up to that 23% retracement where the S&P and the Dow are. The Dow has been above it for 6 months now. The S&P has just kind of been above it for the last month or so, just on the day-to-day basis. And then your NASDAQ has been so far below it, it finally caught, those last 3 months, you can see it finally caught up to where it's at there. So that's the NASDAQ. Then the Russell 2000, the last 3 months have been bearish for the Russell. The last 4 months have been bearish as we've been declining back down to last year's lows. And now you can see the intermediate line is actually in bearish territory. So you have, and you're so far below the moving average, 13% below the moving average, that it's actually turned red. I mean, that's bear market levels. Again, you could argue when you look at the moving averages as well, since we're below the 200-week moving average, you could argue this chart, the intermediate line, this doesn't get down there into bearish levels unless you're in a bear market. So you could argue right now that the Russell 2000 is in bear market levels here, as it's been kind of grinding down. It's not like it's been a one big drop and then by the time we get the dark pink shading and the red line, we're already rallying. And kind of similar situation over here too. Here it's we've been declining. Like I said, we're down for 4 months in a row here. So you can see the dramatic difference there. The weekly chart again finishing up. We got 2 more days left, but so far still pretty strongly bullish on the S&P 500, though not on the Dow nor on the Russell 2000 for that matter either. Russell 2000 still kind of showing a transition there, but the Dow continuing to show lower closes on the Hakunashi, and as I mentioned yesterday, breaking below that 200-week moving average. When you look at the 3 green arrows charts, we're back to 3 green arrows on the S&P. We're back to 3 red arrows on the Russell 2000. We have 1 small green arrow there on the diamonds, but you can kind of see again the charts on the right, which are less influenced by large cap tech, and then the charts on the left, which pretty much are very strongly influenced by large cap tech, look very, very different from each other, diverging away from each other there. The S&P still is above its 8-day moving average. The diamonds, of course, are not. The diamonds are below the 8-day and the 17-day. They both are below the 30. The 30 looks like it's trying to cross below the 50 there. When you look at IWM, again, it's also broken back down below all these moving averages after kind of getting back above it a couple days ago. You're back below the 30. You're flirting with the point of control. And the MACD, stochastics is in bearish territory. So the MACD is below its moving average, is almost negative there. So the Russell 2000 is kind of showing a lot more bearishness. Looking at some of the other oscillators, you are above 30 still, but your negative indicator is not below 20. IWM is the flip-flop. You just had a crossover there with the negative line crossing over the positive. The positive's not below 20 yet either, but the negative is above 25. Your diamonds are still showing a very bullish or bearish pattern there. The positive is below 20, the negative is above 25. You have a slowly rising ADX there. We failed to get above 60. We got a divergence showing up on the CCI. Failed to get above 150 there. So things are looking like they might be weakening on the S&P. Of course, we are in bearish territory still on the Dow, flirting with getting back below minus 100 on that. The Russell 2000 also dropping below 50, below zero, into bearish levels too. So you see a dramatic difference as the NASDAQ RSI is still above 70, and you got that tremendous divergence on the CCI playing out. So very, very overbought on the NASDAQ, and it's starting to play out to some potential weakness there. There's your S&P bullish pattern, again, largely because of the Qs. You're above 5 now, you're above 80, so you have reached very mature trending levels there. Very strong rate of change. The red line's way up above the price there. So you have achieved that. Of course, not the case for the diamonds where there's no trend and you're at the bottom of the cloud, and IWM is also back below its cloud, and you're starting to develop a weak bearish trend after a whole expiration cycle of pretty much going nowhere there. So finally look at the Bollinger Bands, and you can see you're in the upper half, not in the upper quartile anymore. You're in the upper half. Remember the Qs broke out above the bands a few days ago, right there, broke out above the bands right there. So we were close yesterday. We're still in the upper quartile today. The bands, very strong momentum. The bands we're still above the Keltner channel. So that's something to keep an eye on there in terms of if and when there might be any weakness in that. Your diamonds, drop back into the lowest quartile. The bands are still inside the Keltner channels waiting for some kind of breakout move in one direction or the other. IWM, you're in the lower half, flirting with the lowest quartile, and we've had a bullish run, a bearish run, another bullish run, and nothing, right? No trending move coming out of it as the bands have stayed inside, and now it appears to be looking like we're alternating towards the bearish run on the Russell 2000. So we'll see. I mentioned in class today that the NASDAQ 100 here, the NASDAQ 100, the 30-week moving average is crossing above the 50. That generally produces a return move where we pull back now. After breaking out above here, we generally pull back from the break to the breakout point. And the question is, as we pull back on this, how bearish will it be for the Dow and the Russell, considering, again, the Russell 2000 is already below its 200 weeks. So you could, again, argue the Russell is in a bear market, albeit very weak bear market, but is in a bear market. And the diamonds, as we saw in the market forecast, actually is in an intermediate decline, right? Because we've had, 5 weeks of declines here. As we are flirting with getting below the 50-week moving average, we are below the 30 weeks. So we are filling in the gap between the 30 and 50. That's intermediate decline. It's pullback. So we are in a pullback mode there. We are in a bear market mode on the Russell. Very weak in both instances, but bearish nonetheless. And what's going to happen if the Qs decide to have a return move where after breaking out, in this case getting the crossover on the moving averages, you just get a pullback down to the moving average. Remember, you don't really have a pullback until you break the 30 and start flirting with the 50. And obviously that's, you're well up above the 30 there. We're near, as you can see when you look at this chart, how far up above the 30-day moving average we are right now. We're 15% up above that. That's, we haven't been this strongly above the moving average since the post-COVID rally. I mean, this is higher above the 30-week moving average now than we were pre-COVID. Even before that, you have to go back years to see how high. Like, look at that. Like, this is where we're at right now. This is the peak we got above the 30-week moving average. The pre-COVID peak was pretty high, and then you'd have to look at the peak coming off of the pre-COVID peak and the move coming off the bear market low in 2008. So, regardless, we're not coming off of a major low point here. This is a correction, but we're not coming off a low below the 200-week moving average, nor are we coming off of a reopening of a shutdown, of an economic shutdown. So you've had quite the move here to get the stochastics to be strongly bullish, to get the MACD as high as it is on the weekly chart. You're due for that return move, and it appears that we might be leaning in that direction here sooner rather than later. The S&P, you can see, remember the really important thing to watch on the Qs is this gap right here. If and when this gets filled in, when will we fill it in? We did have a lower high and a lower low. We closed below the low point, so we did fill in the rest of this gap there. The diamonds, you can see, is actually more bearish. We did not close above yesterday's low, or below yesterday's low on the diamonds. We did on the Russell 2000, lower high, lower low, closed below the low. We still closed above last week's low, fortunately, because that's kind of, I mean, you get below that low, there's not a whole lot of volume here. We can start to pick up the pace. Of course, your Qs, that's not the case. The Qs are still very strongly higher. So you look at the Arun indicator, you're still not close yet to a reversal pattern. You're almost to zero, a couple days away on the red line, and remember, it takes 6 days to go from 100 to being below 70 on the green line, and that's when you're susceptible to the reversal, like we've already seen on the diamonds, and you would expect that we'll see here sooner on the Russell than the S&P 500. I showed you today's range, and volume was relatively light. Again, 3-point range, 4.5 was the average. We did have a lot of volume, 109 million shares. Again, you put those numbers in the context. It's very small. The range is really, really small. We're just barely above 1%. That's kind of the level that you break it, then we are just going to grind higher. But it's really low, so it's, you would expect that you'll bounce off of this, especially if volume continues to pick up. 109 million's up here. That's going to start bringing volumes up, and that's bearish when volumes start to rise, not necessarily bullish. Finally, when we look at the volatility index, again, really low. A little bit of a bounce up at the end, but still, until you break above 20, until you break above really 95%, you're still kind of either in neutral to bullish levels on the VIX, and you have to break in the VVIX itself, considering that correlation there, would have to break up above 100 and stay there for a while. Your VIX is really low. It's still set up for that bullish move as that we seasonally get over the course of the summer. But you are above that 30-day. We were below that earlier today, as you can see there. So now it's just a matter of whether we get into this gap between the 50 and the 200 and then beyond. Last time we had that was in the banking issues were a deal, and we haven't had very much volatility since then. But that's, again, when you look at the seasonality of it, of the VIX, there tends to be some volatility here. Let's go out to the full 20 years. There tends to be some volatility. The July 4th drop you have at the end of June, going in through the holiday into June, into the earnings season, and then you can see you start to pick up by the end. We're a lot lower now than we are on average from year to year. So the question whether that low point was already happened, and if and when we'll start this increase in volatility that we seasonally get towards the end of the summer. Right now, let's take a look at what's driving this action here. Here's the 3-month chart, but let's just move into today. So we'll go May 31st, and you can see not necessarily the most risk-on day. The Qs were down, the S&P bringing the S&P down with it. IWM was down, though off of its lows. Emerging markets, developed markets were really down here earlier today. The dollar was strong early, came off of its highs. Gold was up along with. You had gold, the dollar, and bonds up today. That's the triumvirate, right? That's the three safest of safe haven trades. Usually we've seen the dollar up with like commodities and yields, right? And that's not necessarily a safety trade, but that's been what's been doing so well during the bearishness of the markets of the past year, of 2022. Not the case today. Commodities are down. Yields are down as bonds had the biggest move of all these classes to the upside, at least. Commodities had a slightly bigger move to the downside. And like I said, international equities down with the strength in the dollar. Let's take a look at some of these charts of those particular asset classes. So let's go to the dollar first. Let's go DXY. And you can see you are flirting with getting up above that they're getting to the 200. The UUP actually is flirting with getting above the 200-day moving average. Again, this is an ETF that's designed to track that index, so it doesn't trade exactly the same. It's actually near its March peak, whereas the dollar index is not quite to that March peak yet. And of course, above the 200-day moving average, you can see the volume here on UUP. You're about to clear a pretty significant hurdle of volume as we've been grinding away to the upside. So the dollar is actually at a kind of poised to make a strong run to the upside. Looking at bonds, you can see it's also poised for a little bit of a bullish move. Now, the point of control is above it, so there's going to be some resistance here. You also have this 23% retracement line that you'd have to get back up above. It's failed multiple times to get above it, but it's poised now. The MACD is above its moving average. You're above the 17-day moving average. You're a little bit poised for a run on long-term bonds, the longest of terms, right? This is even longer term than the 10-year yield, which is down below that 3.6, below 3.64%, kind of sitting right on its 23% retracement level. You can see it's a big reflection in the difference in odds here. The odds for a rate hike was over 70% today until the vice chair of the Fed came out and was basically saying that they expect a pause at this meeting. That's generally the way the Fed starts to put leaks out in terms of what they're going to do, is by because Powell doesn't speak very often, and because everybody just hangs on every word he says. But when the vice chair comes out and says something, he's the one that's obviously closest to Powell. Big drop in expectations for a rate hike. But what's also dropping is expectations for rate cuts by the end of the year. You can see we had a 96% chance for a rate cut. Though, again, the odds for a rate hike dropped in June, but not necessarily in July. You can see they're still pretty high. Dropped a little bit, but they're still pretty high here. You still have about a 65% chance of a rate hike between June or July. So you're pretty well expected to get to 550. You can see when you look at the historical for July, 550, which is in red, was well above 60 and 80% for quite a while. So pretty good chance that it will get to 100%. So we'll get to 550. Not the case for the 575. Even if you look at the September odds, again, here's the red line is the 550 mark. Again, you're above 50 or 60 and above 80 for quite a while. So pretty decent chance. You'll get above there. The issue is going to be, of course, when they start cutting, and the odds for rate cuts are just dramatically lower, going from only a 4% chance, or really a 0.3. If we get to 550, a 0.3% chance of not having a rate cut by the end of the year, to now 11% chance. So still low probability, but definitely this is the big one that's jumped up here. You're at a 39-40% chance of no rate cuts from this point that we're currently at, where it was only 4.5% a month ago. So pretty dramatic change. It was, that's down. It was a little bit higher. It was at 54% yesterday. But that's having an impact. The 3-month yield, which is interesting that the odds of a rate hike dropped so much from the futures contract, but when you look at the 3-month yield, it did not drop. The bond market's actually still, those are pretty high odds for a rate hike in June. The 3-month yield's like the effective Fed funds rate. Remember everyone talked about how it was the 1 month that was so high because of the debt ceiling. Obviously, it's dropped back down far below where the 3-month is. It was actually quite a bit above it. You can see we peaked at 5.77% before dropping 50 basis points here. So this has a lot to do with the debt ceiling, but the 3-month is actually kind of, again, a proxy for the Fed funds effective rate. Let's see here. There we go. The Fed funds effective rate there, and you can see it's still at 5.4%. 5 points, so that's a pretty decent. It's not reflecting a drop in odds. So I think that's an issue that still needs to play out. Let's take a look at the breadth of the market here across some of these charts that we typically look at. Let's look at our new highs and new lows, dropping to minus 270. Again, we're so very negative. So we're still not getting any good breadth whatsoever. In fact, when you look at the number of stocks above their 50-day moving average, we've been flirting with the 150 stock level, which is the 30% mark. We finished right at 150 by the end of the day today. So well below the moving average. Again, this is typically, these are bearish levels to be at 150. The market, the S&P is typically well off of its highs, as you can see in past examples here. For example, here would be one right there, and then this other time right here. I mean, well off of highs by the time we got to that point, and not the case. Even the average being almost being below 225. Again, we're typically way off of those highs by the time the average even gets to that point. So the breadth is really, really light. When you look at the McClellan oscillator here, it is down to almost minus 200. You can see we're still in bearish levels at minus 18, though we're not below minus 35, so we're not trending to the downside, but we're also not above positive 35 either to support an upward move. So, and to be below minus 200, to be at minus 200, you're typically pretty darn, I mean, you can see you don't get below that during bullish runs. You don't get to minus 200. You tend to get to that, obviously, when you're in bearish moves, and you're, again, typically well off the highs by the time you get to minus 200. So the breadth is this, the breadth shows just how bearish we actually are, of course, masked by the Magnificent Seven. But looking at the money flow, you can see the money flow is almost back down below 50, so dropping pretty hard. Again, the last, the biggest peak here recently on the money flow itself was on April the 28th, where we closed at $415.93. We're $2 above that on price, even with the pullback, and yet the money flow is nowhere near that level. So we're continuing, even over here, you can see on the February 2nd, which is that peak of the money flow during that period, we were at 416.78. We're $1 above that level, and of course nowhere near that on the money flow itself. And then of course the peak on this run was right here. We closed at 407.68, and we're well above. We're $10 above that, and the volume is just not supporting that move whatsoever. So no money flow at all, and the money flow did not get to the money flow index did not get to bullish territory. It's actually flirting with getting back into the lower half of the chart and flirting with bearish levels already. So again, from a breadth and volume standpoint, we're a lot more bearish than what we seem, again, simply because of what we're seeing on these market cap weighted index, when you have 7 companies that just dominate this particular chart, as well as a QQQ, of course, but have very, very little influence on the diamonds and the Russell, which themselves are in various stages of bearishness, weak bearishness, because the market, I mean, obviously they're not going to be strongly bearish if the Qs are going parabolic to the upside, but they are in various stages themselves of being bearish. Let's take a look at the sector moves, and again, we continue to have, if you take a look at the 12 grid here, we continue to have 8 of the 11 with bearish market forecast patterns, right? The energy got a cluster today. Materials dropped below its cluster lows. New lows and industrials, their recent lows. Financial flirting with that. The only things that were higher today were our safety trades. So when you look at, again, the one-day chart, comparison chart, here's what's been winning. Technology, communication services, even discretionary is decoupled from those two, as those two have just done their own thing, and even Amazon, Tesla are not nearly as bullish in the discretionary space, and discretionary is decoupling, which is another sign necessarily that we're not as bullish as we think we are. But if you look at this chart, I mean, this was a risk-off day. Utilities, real estate, rising with the drop in yields. Healthcare rising, staples were doing well until the very end, but you can see even technology and communication services are doing well again till the very end, but consumer discretionary was not, right? It's actually decoupled away from these two, which are being driven largely with AI headlines, and then discretionary is down here with these other cyclical areas that are more attached to actual economic growth and earnings growth expectations. All right, let's take a look at our trade idea. It actually happens to be in one of those strong areas. United Healthcare up 1.5% today, producing a bear tag. Remember, bear tags either start decline or continue declines, or start new rallies to the upside. The intermediate line has been pretty bearish, not bearish enough to bring market sentiment down. It's still rising, but has been bearish and is flirting with getting back out of that lower reversal zone. When you look at the weekly chart, again, we had been bearish, but we're flirting with a transition candle right now after just really a couple weeks of being bearish and not really getting that significantly bearish. In fact, we've been getting progressively less with every new move to the downside. When you look at the 3 green arrow chart for UNH, you can see we did get 3 green arrows today, so a good move with more than 1.5 times the average volume. So pretty good chance there that the decline is over with. But you can see though, like you still got the point of control above you. You did cross the 17 and the 30-day moving averages at the same time. You're still below the 50, and you got the 50 and the 200 gap to worry about there. So you still got some room for it to kind of be more neutral than directional. You can see the DMIs are both below 25. That's the positive has dropped, but the negative, has dropped, but the positive did not rally. Looking at the RSI and the CCI, they were in bearish levels. Now they're just barely out of bearish levels, but not necessarily bullish either. Looking at the Ichimoku cloud, you can see that we're still below the cloud. Though we are above the blue line, we're still below the cloud there, and no trend at all. Like we had a little bit of a trend going there, but you can see when you look at the Keltner channels here, that we've had, we've had a bullish move. It had turned bearish without the red dots, right? We just stayed, we flipped that quickly to being bearish with the band still outside the Keltner channels. They have since moved into the Keltner channels, and now you expect we'll probably get some kind of transition from being bullish to bearish to being bullish. Again, you can see the upside and where we can get to, but you got a low bandwidth that's falling. You're just in the middle of the chart of the bandwidth, and you got that point of control acting as a pretty decent center of gravity for the stock. So what I decided to do was what we typically do in these kind of situations is sell some verticals around that point of control. So we'll sell the 460, which is kind of mid 20 delta. Same thing. It was relatively mid 20 deltas when we got into this during the Market Outlook Live. And then buy one strike away for protection. That gives me a pretty decent reward for far less risk. And the reason why is you do have earnings coming up before July expiration, so that's something to keep an eye on. So you're getting with that extra risk, you're getting a regular reward, but now I don't have to worry about maximum loss, as my maximum loss is far less than what my typical maximum losses on these trades. So we're accounting for that risk with it's a high probability, but also probability and risk are positively correlated, right? So when you do high probability trades, you're also high risk trades. So this is a relatively high probability trade, but we're going to reduce that high risk to a degree in a worst case scenario, while still getting a pretty decent reward for normal in the best case scenario. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up in a new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.